Hi, Gigi from the RBA. This video is a brief summary of current economic conditions as published in our November Statement of Monetary Policy. As for much of this year, the COVID-19 pandemic and responses to it continues to dominate global events. This chart shows the number of new COVID-19 cases relative to population size in different countries and regions around the world. Notice the scales on the top and bottom of the chart are quite different. In places like Europe and the US, COVID-19 infections are increasing again. In Europe, many countries have reimposed nationwide lockdowns in October to try and contain the virus. In Australia, infections have declined significantly in Victoria, and in response, many restrictions on activity in Melbourne and the rest of Victoria have been eased. So how has this affected the global economy? This chart shows GDP growth around the world since the pandemic began. The red dots show the initial contraction in GDP experienced in some countries. For most of them, this happened in the first half of 2020. Australia did much better than many other countries during this period because of our early success in dealing with the virus, which allowed the government to ease restrictions on our activities earlier than initially thought. The blue bars show the change in GDP from the start of this year to the end of September. The bars are smaller than the red dots, showing the global economy began to recover as restrictions on activity eased. However, you can see that the recovery has been uneven across countries and that economic activity almost everywhere is well below its pre-pandemic levels. The notable exception is China, which so far has managed to avoid a second wave of infections and has lifted most restrictions on domestic activity. Recently, though, the global recovery has slowed. Its unevenness is expected to continue as new infections accelerate, like we saw on the previous chart. Containing the pandemic and ongoing support from fiscal and monetary policy will be crucial to helping the recovery continue. We can see the uneven shape of the economic recovery in Australia through its effect on the labour market. This chart shows the cumulative change in employment and hours worked since February, split by Victoria in the blue and the rest of Australia in yellow. On the left-hand side is the number of people with jobs, and on the right-hand side is the total hours those people worked. Although employment and hours worked rebounded more quickly than we had earlier expected as the economy opened up in May and June, the recovery has since slowed and remains well below pre-pandemic levels. This is especially so in Victoria, where employment and hours worked fell substantially from July to September because of the renewed lockdown in Melbourne. So of the 870,000 losses in employment between March and May, about half have since been recovered. It's a similar story with total hours worked, though all of the recovery has been driven outside of Victoria. In addition, many people still have a job, but are not working as many hours as usual. Many of these employees benefited from the government's JobKeeper program, which provides a wage subsidy to businesses affected by the pandemic to help them keep their employees. Around 900,000 employees were working less hours than usual in September, half of them full-time workers. We call these workers underemployed. This number has also fallen in recent months and, except for Victoria, is around half as large as in April. So one place the loss of jobs and hours is felt is in households' consumption of goods and services. This chart shows the value of consumption in blue and disposable income, that is, income available for spending, in purple. To the right of the line here are our forecasts of consumption and income over the next couple of years. Consumption declined sharply over the first half of 2020. At the same time, the things that households consume have changed a lot. Spending on travel, cafes and restaurants, and clothing and footwear have all fallen sharply. In contrast, spending on food, household goods, and also spending online has increased as people have stayed and worked from home much more than they normally do. At the same time, we can see that households' disposable income has actually increased through this period, despite the large losses in employment we just saw. Households' incomes were boosted by government support measures, JobKeeper, expanded social assistance payments like JobSeeker, and the option to make early withdrawals from superannuation accounts. An increase in income, alongside a fall in spending, has led to a very large increase in household savings. Some savings was a precaution against the risk of lower income in the future, but some of it was also forced, as households' ability to spend on certain things like travel overseas was constrained by health restrictions. You can see that consumption is expected to rebound strongly over the second half of 2020, as easier restrictions increase spending opportunities and as confidence improves. Households are expected to spend some of their accumulated savings and will benefit from a further boost to their disposable income from continued government support and the recent income tax cuts brought forward by the government. However, at the end of this year, consumption is expected to still be around 5% below its pre-pandemic level. Disposable income is then expected to decline as some of the government's initial income support measures begin to unwind. However, the announcement of a number of new policies in the Australian government budget in October, along with forthcoming budgets from the states and territories, will provide ongoing support to households and businesses, particularly through the creation of jobs. This is expected to underpin the ongoing recovery in income and consumption. Monetary policy has also supported households and businesses through the pandemic. In November, the RBA board announced a further package of policy measures, building on previous announcements in March and September. These are designed to support job creation, Australia's economic recovery, and to complement the government's fiscal policy measures. The package of measures included a reduction in the target for the cash rate to 0.1% and in the interest rate on exchange settlement balances to 0. Forward guidance on the future path of the cash rate target, which will not be increased until actual inflation is sustainably within the target of 2 to 3%. This is not expected by the board for at least 3 years. A program of asset purchases. So the price target for the yield on 3-year Australian government bonds is now 0.1%. A quantity target for purchases of bonds was also introduced. Under this, the RBA will purchase $100 billion worth of longer-term government bonds over the next 6 months. This policy is sometimes referred to as quantitative easing or QE. And finally, the rate on new drawings under the Term Funding Facility was also reduced to 0.1%. All of these policies will support the economy through the regular transmission channels, lower borrowing costs for households, businesses and the government, a lower exchange rate than otherwise, and higher prices for some assets than otherwise, making it easier for households and businesses to borrow and increasing their confidence to spend. In the description, there is a link to an Illustrator where you can learn more about these policies. I would also encourage you to listen to the Governor's recent press conference on the package. See the link for that as well. So that's an update on the economy. Where do we see things heading? Well, of course, as throughout COVID-19, the future is highly uncertain and hinges on the path of the pandemic. This chart shows some scenarios that RBA staff have put together for the unemployment rate over the next couple of years. The pink line is our baseline expectation for the unemployment rate. This scenario assumes that Australia sees no further large outbreaks of the virus and that restrictions are not tightened materially at any point. However, some restrictions on overseas travel are expected to remain until the end of next year. This scenario sees the unemployment rate increase in the near term, even as the economy recovers. This is because many workers who lost their jobs early in the pandemic decided not to search for work for a while, and as a result were not included in the unemployment rate. Many of these people are expected to re-enter the labour market to search for work again, as job prospects improve in some places and as eligibility criteria tighten for social assistance payments like JobSeeker. This will see these people included in the unemployment rate. Under this scenario, the unemployment rate is expected to peak a little below 8% around the end of the year, before declining to just above 6% by the end of 2022. In the downside scenario, Australia sees some major outbreaks of the virus, experiences tighter restrictions, and a longer closure of overseas borders. Here, the unemployment rate peaks at 9%, before declining a little to 8.5% by the end of 2022. An upside scenario is also possible, where there's additional progress in the control and treatment of the virus in the near term, even without a vaccine. This would boost confidence in spending by households and businesses. Here, the unemployment rate is expected to decline faster, reaching around 5.5% by the end of next year. Under all of these scenarios, there will still be significant space for a further recovery in employment over this period, which means that increases in wages and prices are likely to be low for some time. On this chart, we can see how inflation, that is the extent to which prices in the economy are changing, is expected to evolve over the coming years. Inflation is important for the Reserve Bank because along with supporting full employment, we target inflation between 2 to 3% per year on average over time. The measure of inflation we are looking at here, trim mean, ignores goods and services with the largest price changes to give a sense of how the prices of most goods and services are changing in the economy. During the pandemic, looking at measures of inflation like this has been important because the prices of things like childcare and petrol have moved around a lot. Under our baseline scenario, trim mean inflation is expected to bottom out below 1% in 2021 and reach 1.5% by end 2022. In the downside scenario, inflation is expected to weaken further, and in the upside scenario, price pressures are expected to build a little more quickly. In any case, inflation is expected to remain below the RBA's target range for a while. For inflation to pick up will require significant gains in employment, a return to a tight labour market, and bigger increases in people's wages. As a result, the RBA will continue to do what it can and is prepared to do more for as long as necessary to support the creation of jobs and the economic recovery in Australia. Thanks for watching this update on current economic conditions. Links to more information on the material in this presentation are in the description. See you next time.